Hello guys, and welcome to my YouTube channel once again. In today's video, I'll be doing a follow-up of the last video I posted in this channel. In the last video, we talked about where to anticipate spikes. So in this video, I'm going to add another way of catching spikes. Also very easy way to catch spikes, guys. Alright, so what we're doing for this particular one, what we need to do is just to use the 15 minutes time frame. First, we look for the engulfing candlestick pattern on the 15 minutes time frame. I'm using crash 500 as an example. You can try this on every other pace. So you use 15 minutes time frame, then we look for, we wait for a candle that will close, a spike that will close to form an engulfing candlestick pattern, bearish engulfing candlestick pattern. Once a candle closes and gives the bearish engulfing candlestick pattern. Now, what is bearish engulfing candlestick pattern for those that do not know? Bearish engulfing candlestick pattern is a candlestick pattern where we'll have two candlesticks, whereby the green one, the first one is the green candlestick, while the second one is a red candlestick. Then the body of the red is bigger than the body of the green candlestick, so it engulfs the green candlestick. So we say it's a bearish engulfing candlestick pattern. That's what we'll be looking for on the 15 minutes time frame. Examples of bearish engulfing candlestick patterns on this chart. Look at this. This is a bearish engulfing candlestick pattern. This is a bearish engulfing candlestick pattern. This is a bearish engulfing candlestick pattern. This is a bearish engulfing candlestick pattern right here. Here's another one here. We have so many on this screen. This is bearish engulfing candlestick pattern too, guys. This is bearish engulfing. You can see the red candle is bigger than the body of the red candle is bigger than the body of the green candle. All right, so after identifying this candlestick pattern, like it must be that it closes, you are on the chart while it closes, while the candle closes and forms this bearish engulfing candlestick pattern. The next thing you know from what we did in my previous video, we know that once we have a bearish engulfing candlestick pattern, it's a signal that the market might be bearish, will possibly be bearish for a little while, depending on the time frame you are seeing it. But on the 15 minute time frame, if you see this, you know the market is going to go a little bearish. Then if you are seeing this on crash, it means the market is going to spike. The next candle must have a spike. Within the next 15 minutes, you should be able to catch a spike. That is what it means. Once you see bearish engulfing candlestick pattern on crash, then the next candlestick must give you a spike or spikes depending on the market at that time, guys. It mostly does not fail. And if the next one does not give you, the next one, the one that follows it, must give you a spike. All right, so without wasting your time, we'll have to go down to see how we can do it. Now, first of all, like in every other pace, once you have this bearish engulfing candlestick pattern, guys, maybe the candle just closes and forms this engulfing candlestick pattern, you are not supposed to enter the market immediately it closes. Don't enter immediately it closes. The strategy I'm going to show you in this particular video is a kind of a sniper entry to catch spikes. If you have, I believe so many of you may have joined some Telegram groups or a lot of signal groups that they will tell you enter a trade and put a stop loss at 20 candlestick. No, it's too much. I don't do that. What I'm going to show you is a way of getting it at the sniper entry. Maximum is 2 candlesticks. You stop the trade, you close the trade and wait for the next opportunity. This strategy will make you good money, even if having it all the time might not be possible. Like you might have up to like three good trades in a day. Besides, you're not doing this just on crash 500. This works on crash 1000, works on boom 1000, boom 500. You just need to wait to get this formation. Once it happens, it's a very high chance of making up to even 5 or 10 trades a day, depending on how much time you have to spend on the chart or to be monitoring the chart. You get? All right, so this is what is going to happen. Once you notice that the candle that has formed, the current candle has created an engulfing candlestick pattern, and as it has closed, you do not enter immediately at the opening of the next candle. The reason is, most times when you enter, the market does not continue with the spike immediately. It retraces and goes up for a little while. Like for example, if you can see what happened here, where is it? Okay, like this, an engulfing candlestick pattern. You see the next candlestick that formed had to go up a little before it started spiking. It did not spike immediately at the close of this particular one. It waited. Perhaps I should zoom it more so you understand what I mean better. Moment, please. I need to get this thing clear. Alright, so you see this candlestick here, after it closed, it formed an engulfing candlestick pattern with this particular green candle here. At the close of this candle, the next one did not just spike immediately. What it did was it went up first. It went up first and got to this level before it started spiking. So you cannot enter immediately except you want to put your stop loss here. And putting your stop loss here, how many candlesticks are you risking? What if it doesn't even spike, guys? So we don't do that. What we need to do, how I'm going to show you, is a way you'll be entering at sniper entry, and this is far more profitable, guys. All right, so how do we do it? Once we notice this engulfing candlestick pattern on the 15 minutes time frame, guys, I want to show you a secret. I want to show you a secret. So stick to the end of this video. Ensure you watch this video to the end. Now, candle spikes can never occur just anywhere in the market. Take note of what I'm just telling you now. Spikes only occur where there is a little let's say like a reaction in the market. That's where it can occur. There must be a little support or resistance somewhere. Spikes occur as a reaction to something that had happened in the past around that same region, that same line. That is where the spike will come. It doesn't just come out anywhere. So if you want to enter to catch spike on the 15-minute time frame, you might be losing a lot of money. So what we do, we go down to the 1 minute time frame, guys. 1 minute time frame. So let's go down to the 1 minute time frame. Oh, before we go down to the 1 minute time frame, let's try to identify where, because I want to consider this particular spike here, this bearish engulfing candlestick pattern. So I think I need to mark it. I need something to mark it. I need to mark where the main candlestick closed. This candlestick closed. This is the closing. You see, this candle closed. This candle closed at this point. So I have to mark it. Then I have to identify the candle that made the bearish engulfing candlestick pattern. I think I need to use something like a line like this. This is the candlestick that formed it. And let me move this line. Let me use a kind of a rectangular box to mark it. And this line is the close. I believe you understand what I'm doing. I believe you understand what I'm doing. So let's go down to the 1 minute time frame so we can identify this. So now on the 1 minute time frame, look at it on the 1 minute time frame, guys. Let me zoom out a little. Okay, you see, this is where the bearish engulfing candlestick pattern closed. After it closes, then you come down to the 1 minute time frame, because we are expecting a spike to come. There must be spike, even not on the next 15 minutes, within the next 15 minutes, but the next candle must bring us, the next 15-minute candle should bring a spike. So once you get to this 1 minute time frame, guys, what you need to look out for is the nearest would I say a zone within the 15 minutes, within the bearish, because this is actually the bearish engulfing candlestick pattern. This is actually the candlestick pattern here. What we are looking at for now is a zone where there were reactions in the market around it, because that's where we should expect the spike. And if you look at this place, see there was a reaction here. Market got here, the price got here and went back up. See this same zone here. Price got here and spiked down. Price got here and spiked down. This is the same zone here. Price got here and spiked. Price got here and went up a little. So tell you that this is a very strong zone. Market will always react where there was a reaction previously. So, and if you want to mark with another, let's go to the 15-minute time frame also. Let me try to say something. Okay, there's something I wanted to on this 15-minute time frame. Okay, we can just mark this. You can just mark the closing of that bearish engulfing, sorry, the candlestick that formed the bearish engulfing. If you mark this now, you see we have just placed the line. You see, look at this, guys, the closing of this bullish candle, and this is the opening of this other bullish candle which was engulfed by this red candle. So if you mark it now, that's showing you this is a strong zone, guys. So when we go down to the 1 minute time frame, guys, you see something. You see, then once we notice this zone is where market always, this is where market has been reacting and reacting, the next thing we'll do is to just put a sell limit. Mind you, this he just occurred here, so you have to go and set a sell limit. You are setting a sell limit and putting your price around there. Personally, I'll put my price, let me move this line, I'll put my price somewhere here. I must not put it directly on that particular line. I can put it like 2 candlesticks away from that line, or a candlestick away from that line, because the market may not just spike at the exact point where you expect it. It might be a little below, slightly below, or slightly above, but it must be within that range, guys. So you see, if you put your sell limit down here, once price gets here, you get this massive candle. Actually, I traded this particular spike. And it gave me, I used a very big lot size, because when I want to trade, enter a trade that I have some level of confidence, I usually use a big lot size. Besides, catching spikes is less risky if you know how to enter. It's far less risky compared to trading against spikes. So because of that, I know if I want to risk as high as it's 2 candlesticks, if it doesn't go my way, then I will close. I'll be at a little loss. But since this catching spikes, I decided to use, I think I used about 10.0 lot size. Yes, on this trade, and it gave me about $106 or $108 with just this spike here. It spiked twice. The first spike stopped somewhere here. It stopped somewhere a bit here like this, I think. Then the next one continued to this point, guys. So that is how it works. That is how it works. The spike will come wherever there was a reaction in the market, and that reaction must have happened within the body of this engulfing candlestick. This is actually the engulfing candlestick, the big red candlestick that engulfed the green candlestick. The reaction that happened within here is where you enter the trade. Now, let me emphasize on something here, because maybe you see this and then you think it must happen here. Most times it doesn't, because like now, this one major reaction that happened here, this is another reaction that happened here in this market. See this place. See, look at this here, and look at this. You see, so most times this one might fail. So that's why I say after 1 or 2 candlesticks you close, target the next zone where there was a reaction. Target the next zone where there was a reaction. So you place your sell limit right here now. If the first one failed, you place your sell limit right here. If this one fails, you win on this one. You win on this one. Then if it fails, you check the next one. Before the end of this 15 minutes candlestick, you get a spike, and the spike you are going to get will cover all the little losses you've made, and you'll be in massive profits, guys. This strategy is working. Honestly, it's working. I'm telling you guys, you can use it to make over $500 a day if you are consistent. Just have a balance of, let's say, even if it is $50 on your account. Then when you want to trade, don't be scared, guys. Meanwhile, you have to practice this on your demo account to be sure first. Then even if you have just $50, then you want to trade this on this crash 500. $50 would not accommodate. The margin would not be enough for $50 to trade 5.0 on this. You can trade 4.0, guys. Whether it is 3.5, you trade one spike alone, guys. One spike will give you profits, and it cover any little losses you may have made. Please follow the rules. The video is too long. This is 15 minutes. I would have wanted to try and to show you do another example of this to show to you. Let me see if I can rush, because I actually wanted to make it maybe 10 minutes video. Let me delete this. I have deleted these lines also. Delete these lines. Okay. Then I'll have to go back to the 15-minute time frame to check for another bearish engulfing candlestick pattern. Okay. So we had another bearish engulfing candlestick pattern here. The body of this red, if you look very closely, it is bigger than the body of this green. Why I'm saying so is this. Let me bring the crosshair tool. We zoom. If you can see clearly, look very closely, you see that the body of that red candle has a little below. Although this candlestick pattern, this green and red that are almost the same size, the body is almost the same size, is one they call, is it tweezer tops, is one that indicates a reversal pattern. It is one that indicates a reversal pattern, a kind of a tweezer top. So if you see this, just go on your Google, go and search for tweezer top to understand. So once you see this kind of a reversal pattern, the next thing you do is to go down to the 1 minute time frame and also check where there was reaction previously, that like we did on in the other one. So here we'll just go down to the 1 minute time frame. Let me just mark out first the closing of this. This is the close of the red candle. I put it well. I'm not sure I placed it properly. Okay, that's the close of the red candle. Then let me get the rectangle box to cover the area we are concerned with. Okay, this is what we are looking for. All right, so then we go down to the 1 minute time frame quickly. Hold on one moment, let me get this tool. All right, you can see this is where it happened. This is where the engulfing candlestick pattern closed. Look at what we're having here. This is where it closed. At this point is where it closed. So because it closed down here, and this is the line that we used to mark it out, we have to look for an area where the market reacted within the body of this engulfing, because it's the, hold on a bit, this is the body of the engulfing candlestick pattern. This is the body. So actually this is just like the wick, that wick we are seeing, and I'm not sure, but this is the where it closed. We marked it with this line. This is where it closed, and this is the body. The whole of this is the body of the candlestick, guys. This is the body of the candlestick. So what we do now is, okay, yes, I'm correct. These two green candlesticks are the ones that form the wick if you go to the 15-minute time frame. Yes. So this is where this is the actual place where the body of the candlestick closed, 15-minute candlestick closed. So now we look for where market reacted within the body, because the body on the 1 minute time frame has extended down here. So we look for where market reacted. Guys, see, there was a reaction in the market at this point. Market sold to here, then bought, then sold. Market sold to here, then bought. As you can see, this is not just a single point in the market. What you do is just to mark out, you might just have to place a trade at where you feel is the lowest point, like here. One moment please, let me take out this one. I want to, oh, okay, I think it was somewhere here. All right. I wanted to use the. Oh, why am I moving this thing? All right. So you can see, personally, I would want to put it where we have this lows, just somewhere here like this, since we are having, this kind of a zone here, you know. So if you want to put it above somewhere here, you may lose. So it's better you just put it maybe 1 to 2 candlesticks away from this top, because it might mostly want to react where we will have these little highs here, these little wicks of the previous spikes. So just put like 1 to 2 candlesticks away from those places, and you can see this is a sniper entry and it's so down, guys. Imagine you catch all this. This, in mind you, these spikes are looking small because I am holding my device. I'm holding it putting in the landscape mode. If I hold it vertically, you will see that that's a long spike, guys. I've taken so much time, but the idea is just very simple. Try to apply it on your demo account, and you see you'll be in good profit, guys. What is the idea? You go to the 15 minute time frame. First of all, you go to the 15 minute time frame, look for an engulfing candlestick pattern. If you are on boom, you look for a bullish engulfing candlestick pattern. If you are on crash, you look for a bearish engulfing candlestick pattern. After seeing the pattern, the next thing you do is go to mark out the closing of that the candle that formed it. You can just be back testing this, and I'm telling you, mark out the closing like we did, identify the candle that did the engulfing. Then you go down to your 1 minute time frame, check where the body of the candle ended on the 1 minute time frame where you marked from the 15 minutes. Then check for where we have reaction within the body of that candlestick. Enter your trades, around that zones. Enter your trade just maybe 1 to 2 candlesticks away from those zones. If the first one fails, check the next one within the body. You see, before the close of that body, I'm sure you make some money, because bearish engulfing candlestick or the bullish engulfing candlestick pattern does not easily fail like that, guys. They do not fail. So I implore you to just go ahead and practice this thing I'm just telling you. This is a bomb. See, let me tell you guys, forget about scoring the whole internet for strategies. You might end up not making any money. Stick to this thing I've just shown you. This is a secret. This is a secret you may be asked to pay for, but get it for free. And also, lest I forget, in my last video I mentioned that I have created a Telegram group, which I included the link in the description of the video, and I've noticed I have some subscribers already in the channel or in the group, but unfortunately I've not been dropping signals because of my busy schedule, and each time I analyze the market, the time I have to send the signals has been a little difficult for me. So I will, from Monday, or let me say in a very short while, we'll start having signals on the group. And if you would prefer, if you want us to go live, on YouTube and be trading together, catch some spikes for a little while, or just scalp for a little while, I would love to see your reactions, your comments your comment on this video. Just comment down so that I'll think about it and put it to plan. All right, guys. So without taking so much of your time again, let's leave it at that and have a wonderful day. If you've not subscribed yet, please go ahead and subscribe. You are getting an information that you might have to pay $500 to get. We don't use bots, no indicators, just pure price action, guys. Please subscribe, share this video, like it, and tell me what you wish we will do in the next video, and I will try my best to listen to you guys. Love you all, guys. See you in my next video. Peace out.